short term, I see opportunities in buying downside protection in the options market. You have low volatility, relatively low skew in terms of like the cost of puts relative to calls. You see a lot of stories about zero DTE options right now, and a lot of people are just aggressively buying.
Hello everyone, I'm Giorgio Tavazza and you're watching Avanguardia Investment Media. Today we are joined by Nick Pardini from the Davos Macro Research to talk about markets. Nick, thank you for being here.
You're welcome.
So now, before we begin talking about markets, for those in the audience that don't know you, could you please talk about your background and Davos Macro Research for a bit?
Okay, my name is Nicholas Pardini. I started Davos Macro Research in late 2017. Prior to that, I was primarily a analyst and portfolio manager at various hedge funds in both the global macro and volatility space.
Great. So let's start with the markets and let's start with a general overview. Equities just had the best January in decades, but it seems that this rally wasn't accompanied by improving fundamentals, and the Fed is still raising rates and doing QT. So what is your general outlook for 2023?
Yeah, I mean, I think that what caused the rally was just the probability of a soft landing slightly going up, as the market was pricing in of previously a very low probability of that happening. And even though I still think it's a very low probability of happening, the market's perception of the Fed being able to somehow both cut rates without any sort of recession attached to it has brought back the dash for trash, for a lack of a better term. What I think at this point forward, I think it goes back to just my base case scenario for the last several years, which is just a slower grind lower with a lot of sharp bear market rallies in between. Like the good example is what happened with the Dow Jones between 2000 and 2003. Like the real economy is not going to be that bad, especially in the US. Employment's high. There's still demand for real things, but given rates rising and increasing the minimum effective cap rate for investments and the inflation risk squeezing out people's income, this is going to be more of an income statement driven recession if there is one, and the concentration of the savings being depleted in the economy is going to affect the capital markets a lot more than the quote unquote real economy of physical goods and services.
Nice. And now I want to ask you about inflation. So the market is currently expecting inflation to come down rather quickly. At the same time, we have recently seen a rebound in some commodity prices, and China is reopening the economy. And especially last Friday, we got some labor market data which suggests that wage inflation may continue. So do you believe that there is a substantial risk of a rebound in inflation? And what will be the consequences of that?
I think it really depends on monetary policy. I think the biggest risk to inflation isn't necessarily commodities going through the moon, because I'm not a big buyer of this reopening narrative in China, but more in the fact of real estate prices, especially here in the United States of America. Real estate prices have come off from their peaks last summer, but the main reason for that crunch wasn't due to all of a sudden people losing their jobs and not being able to buy property, or the demographic boom of the millennials needing to buy property going away. No, it was just the Fed keeping that market down through tightening policy. And if the Fed does, like as many people who are more bullish on the market hope they do, ease monetary policy before year end, which would be too early, the housing market will come back a lot stronger than people expect. And since housing is the main cost of living driver and therefore affects wage demands, it will bring back inflation across the board.
Right.
So yeah,
And what
we're
do you
looking at the real estate market for the future of inflation.
Great. And what do you think will be the consequences of a higher inflation rebounding maybe later in 2023?
I think if you did get that outcome, which I'm not saying is likely, again, if housing prices are flat and everything else is 5%, inflation will go down to 2.6% on the core. That's how big real estate is a driver of inflation. So you, by being long inflation, you are betting on the housing market rebounding aggressively. And you've seen that with the home builder stocks outperforming since the end of the second quarter of last year, that there are some investors and who are making that bet. But the consequence is if you get a higher high in inflation, which I think would happen in your scenario, the Fed's just going to have to tighten that much more and cause asset prices to fall that much more to reflect the fact that you can get a higher yield just safely investing in treasuries or very high grade corporate bonds.
Got it. So I think from what you're saying, you're more focused on the real estate market than the labor market when regarding inflation, right?
Yeah, exactly.
Okay. Now, switching from inflation to volatility, last year we have seen an increased volatility in the markets. This year, however, the VIX has declined steadily to lower levels. Do you believe that the market is getting too complacent right now? And what is your outlook for volatility in 2023?
Yeah, I do think that the market is getting complacent relative to the macro catalysts out there. I think that this is an opportunity to buy hedges at a much cheaper price than you would have been able to in the last several years.
Got it. And now another major trend last year was investors selling tech and trying to hide in the Dow Jones. And so the Dow performed substantially better than the Nasdaq or the S&P. When you look at the major sectors today, where do you see strength and where do you see weakness?
I mean, I see strength in industrials and in things that are going to be involved in the global realignment of manufacturing away from China. The winners of that is again like the industrial sector. The winners for that are the construction sector. The winners for that are a lot of non-US international stocks, particularly countries like Mexico, who benefit a lot from the supply chain transition. I think that the sectors to avoid are consumers sectors, both consumer discretionary and consumer staples, as you see real incomes being squeezed by higher prices for things. Even if inflation comes down, it's not deflation, and incomes are not catching up fast enough to make up for just a broader cost of living increase. And that is what's kind of been driving the slowdown. You have the same, relatively the same amount of income coming in adjusted for inflation, but things are more expensive. People are cutting. And so that's why consumers, I think, will lag. So things that will, again, more on the business and industrial side, I think are the winners. I think utilities also have some potential because they have the easier ability to pass on costs in the long run than other industries do.
Got it. And now, as we talk about inflation for a bit, gold many times is referred as an inflation hedge. And gold has started the year incredibly well. And I'm sure many investors were surprised to see gold performing badly last year when inflation was rising. And now that inflation is coming down, gold is having a comeback. What is your outlook for gold and precious metals this year?
I think the thing is that people need to look at for gold and precious metals is real rates. So if you see like interest rates, real interest rates, which is the base interest rate minus inflation, going up, which they did last year because the Fed was hiking rates and inflation was coming moderating towards the end of the year, that's very negative for gold, because gold has as it always has an interest rate, a real interest rate of zero. So if you have real interest rates being negative, that benefits gold. If even if inflation is high, if real interest rates are less negative or they're positive, that's bad for gold. So if you think that inflation will go up faster than interest rates will, you want to buy precious metals. If you think interest rates will go up faster than inflation, or inflation will come down and interest rates will stay the same, then you don't want to be in precious metals right now. Hopefully that helps.
Yeah, that helps a bit, and a lot actually, and especially because many times investors just think, okay, higher inflation, I'm gonna buy gold, and then the problem is that with higher inflation, many times central banks come in and raise rates to fight this inflation, and so gold performs poorly. And
yeah, buying like that's why gold has worked so much better, say, against the euro or the yen than the dollar, because those central banks are not as credible as fighting inflation.
Yeah.
As the Fed is.
And now, talking about currencies, let's talk about the dollar. For months now, the dollar has been declining, and I mean, a lower dollar can have inflationary effects, as the US is a big importer nation. My personal view is that the Fed cannot accept a much lower dollar if they are trying to fight inflation. But of course, I could be wrong here. What is your outlook for the dollar?
My outlook on the dollar is fairly neutral right now. I was pretty bearish on the dollar a lot last year because it was getting really high, and you saw a lot of currencies adjusted for purchasing power parity trading way below. However, my neutral view is somewhat clouded by the fact that I think there's a different outlook for developed currencies versus emerging market currencies. I think the dollar can do well against other developed market currencies because I don't think that the other central banks are going to converge with Fed policy as fast as the market consensus expects. And second, when it comes to emerging market currencies, I think they will tighten as fast, if not faster, than the US because they really have no choice. Those countries can't afford food inflation for their own civil stability. So that's why a lot of emerging market central banks, at least the ones who bother to actually fight inflation at all, I'm not counting the Argentinas and Turkeys of the world, tend to tighten at least as fast as the US, if not quicker, to prevent food inflation from getting out of control. So I think I'm more positive on emerging market currencies versus the dollar, but I'm negative against other developed currencies against the dollar.
Right, and we saw something similar last year with the Brazilian real, as it was one of the few currencies that outperformed the dollar. And you were right because they started tightening way before the Federal Reserve, and also additionally they are a big commodity exporter nation, so they benefited from there. Now let's conclude this interview talking about opportunities. Where do you see opportunities in the markets today?
In the short term, I see opportunities in buying downside protection in the options market. You have low volatility, relatively low skew in terms of like the cost of puts relative to calls. You see a lot of stories about zero DTE options right now, and a lot of people are just aggressively buying at the money or out of the money calls with short-term expirations, and that's kind of changing volatility profile in a way to favor downside protection for those who have a more bearish view on the market. So that's short. Longer term, I think the opportunities are in, because I mentioned before, industrials, international companies, stocks that pay high dividend yields and have a chance to grow those profits over a long period of time. This kind of reminds me of the 2000s market narrative when you had the previous decade, like the 90s, and then this time the 2010s, where investors prioritize growth and potential over hard profits. I think this next cycle, investors are going to prioritize hard profits and income and tangibility over potential. And this is the chance to catch that wave.
Thank you. And now talking about the first decade of the 2000, a lot of people focused on China back then. Do you think China will be relevant in the next decade or less so?
They could be. I just think instead of China, you basically have to have the developed economies rebuild their supply chains and infrastructure. And that's the impetus this time around.
Got it. Thank you. So as we wrap up this interview, how can people learn more about the Davos macro research, and who should they contact if they're interested in your services?
They should contact my business director of business development, Mark Mishkin. I think his contact information will be in the description. You could go on the website mjresearch.org and find also more information, or the Davos website, davosigg.com. The way you can find me is my YouTube channel, Analyzing Finance with Nick. That's the best way to find out more about our macro research. Thank you.
Thank you. And perfect. For those listening, I also know that Nick will be in Europe this summer. And for further details regarding his trip, you can contact Mark Mishkin, and I'll put the contact details on the screen up here. So Nick, thank you again for taking the time to be here today. And it was a great pleasure speaking with you.